Hi, and welcome to Midas Investing. Today, we're going to be taking a look at the company InMode, ticker INMD. They are an up and coming company in the medical device space with a particular focus on medical aesthetics and women's health. They apply radio frequency energy technology to their medical devices to expand into the ever growing minimally invasive aesthetic technology space. And with the maturing of wealthy Americans as well as the rest of the globe, and expectation of healthcare expenditures growing over the coming decade, I see this as a very high potential growing space in the coming years. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So we'll dive right into their recent presentation to show you a little bit of what they're all about. First off, they have this basic overview slide showing their current revenue as well as earnings over the more recent quarters. But more importantly, I want to draw attention to their overall US install base. As you can see, they have over 8,000 installed devices in the United States versus about 18,000 worldwide. So you can see kind of the skew of a pretty large percentage in the United States, but still an even larger amount of potential worldwide. And that's what the current opportunity that they've actually managed to capture. Given that this is a technology company at its core, I think it's pretty important to have an idea of who's running it. Moshe Mizrahi is the chief executive officer and co-founder, as you can see, with over 20 years of experience, coming from being the CEO of Cineron, which is a somewhat of a direct competitor with this newer company, as well as you can see that it was co-founded by this fellow here, Dr. Crindell, who co-founded along with Mizrahi. But as you can also note just by the pictures alone, that one of them is significantly younger than the other. I believe the CEO is in his 70s, while Dr. Crindell is in his mid 50s. And I point that out in particular, being that this is the chief technology officer and was one of the co-founders, as I see him as basically being the shoe-in option for who's going to likely lead the company once the other founder decides to retire. And considering there's a large age gap between the two, I see this as a pretty strong bridge for the company into the future, which I think is very, very important if they're going to be able to sustain their growth into the future. And I think it's important to also talk about where they see the opportunity. What with laser procedures having over 40 million of procedures annually worldwide, they're obviously very focused on building non-invasive technologies. So with things like hair removal, lesions, as well as visible veins and acne, creating a variety of options for people to have non-invasive solutions to these problems. As we had talked about before, with the change in the demographics, there's a little bit of a larger shift towards older populations. Older populations means lots of sagging skin, wrinkles, spots, and things like that. Lots of things to possibly get touched up. And with the focus more towards non-invasive technologies, that gives them the opportunity to steal some share away from other more traditional forms of solutions for these problems, and possibly have less downtime and therefore being able to get back to your life, which is kind of the point. Now, at the end of the day, it's the physicians that InMode's going to have to sell to. So they talk about our obvious customer base being the 100,000 plus surgically trained physicians in the United States, over 200K globally. Then they disaggregate it by different categories, showing how there's actually a pretty large plurality of 45,000 plus focused on the GYN space, with other sections often ophthalmologists, plastic dermatology, as well as ENT. And then obviously this is really just focused on where it is currently. I am going to be using this information as well as other information related to how this can expand over the coming years to help build up my model. My presentation shows many examples of before and after pictures. It has various examples showing one treatment versus 3 treatments, or various sections 4 weeks apart, 6 weeks apart, various before and after pictures, kind of giving you a sense of how these technologies can be used. But one other thing I really liked about their presentation, as well as the way they talk in their calls as well as in their 10Ks, is they seem to have a very strong understanding of how they need to appeal to various different parties in order to sell their products. Not just the customers that are going to be receiving the treatments, but also the doctors that are going to be giving the treatments, as well as the facilities themselves that are going to be purchasing the treatment. So there's a large amount of focus on making the products sellable to doctors, trying to work towards clinical trials, getting lots of papers written on their technologies. And then these are also getting lots of results with lots of peer-reviewed publications. And the buildup of their peer-reviewed publications seems to have a strong corollary factor into how they're getting their FDA clearances, which themselves leads to products being sold. And then naturally, since this is an aesthetic medicine technology, it would be a complete waste to not take advantage of also the celebrity power, using a lot of celebrity endorsements to really bring awareness of their brands, including famous people such as Eva Longoria and Bobby Brown. We'll take a minute to compare InMode to a few comparable companies that I put together some charts on ticker.com. Here we have the gross margins of them against Abbott, as well as Medtronic and Hologic. Just a few companies within the space. Abbott and Medtronic are some larger companies within the space, though each of them do some slightly different things, so they're not entirely perfectly apples to apples. Same with Hologic, but that's another company in the space that people on this channel have definitely brought to my attention a few numbers of times, so I know it's a well-known name, at least to my viewers. And so at least with this small comparable group, you can see InMode has very strong profit margins relative to the other ones. And then if we switch over to the EBIT margins, you can see that they also maintain pretty high levels of strength competitively against them against most of the years going back till 2016, but that's pretty much at the start of their operating history. So at that point, that's when they're really starting to kind of build into their actual operating ratios. And likewise, you can see also Hologic being relatively stronger comparative to the two larger and more mature players within the space. And then moving away from more of operating based ratios, now we have asset turnover, which is more of a measure of capital efficiency. We can see the InMode also maintains pretty strong capital efficiency throughout the historic time frame that we have here, leveling off towards the other comparables in the last year or two. And you can see that they've really all kind of like coalesced around this space in general. I would also call attention in general that this level that it's leveled off to is at about 0.5, which means in relative to the sales that there is about half as much of revenue compared to the overall asset base. So you can see that their overall capital efficiency has definitely started to come down, though again, still stronger relative to this small comp group. And then taking a look about how they're financing these assets, we have total liabilities as a percentage of the total assets, getting just a total look at the way that they've geared their operations. We can see that over the entire time frame, InMode has had less liabilities relative to these assets, and then that actually dropped pretty precipitously from 2018 down to 2019, down into less than 20%, which puts them significantly lower than the other comparables across the entire time frame. And then turning from financial ratios now to more market ratios, we have the enterprise value to EBIT ratio, as well as a normalized PE ratio for all of these companies all put together on one chart. I just kind of wanted to look at it all together to kind of get a broad strokes. Didn't need to separate out the EBIT from the PE ratio. But in general, you can see that across the space, the companies have traded kind of in the high to mid teens for much of the earlier period, but you can see this kind of slow drift upward across the kind of average of these multiples over time. And then there's a larger amount of variance to InMode's multiple that is traded at itself, going all the way up into the 40s at some points, and coming down possibly even to the high single digits at this kind of lower point here. But in general, across the averages for all of these ratios and all of these companies, you can see it's generally kind of in these mid to high teens, somewhat stretching into the low 20s at some points for a various couple of them. All right, now so turning to take a look at the model that I built for the company, we can see here we have financials for the company going back to 2018. Unfortunately, based off of the metrics that I'm using to build up my revenue model from, unfortunately, I could only get information for the company going back to 2018. So it's a very, very limited amount of financial history to work with. But I have R&D expenses here at the top because I'm basically going to be building my revenues off the assumption that the revenues themselves do come out of the R&D expenses. Below that, I have the R&D expenses as a percentage of sales. So we can see that on average over this time frame, they were spending about 3.5% of their sales on R&D expenses. And so likewise, we can also see that they grew from 2018 to 2020 at almost 50% per year. And then that leveled off over the 2 years following that to about 15% per year. So you can see while the R&D expenses were small in nominal terms and they're growing very, very fast, that growth itself is somewhat starting to level off depending on how you look at it. And then this comes into terms of where we think the revenues themselves are likely to go over time. So in terms of thinking about where the R&D expenses are going to go, I assume that in the bull case assumption, maybe it'll grow at kind of the same rate it did for the last couple of years, that 15% or so. And so that's what I did have for my bull case assumption, is assuming 15%. So for my base case assumption, I'm going to assume that it grows at half that. And then for my bear case assumption, I'm going to assume it grows at a third of that. I do think that for the base case and the bear case assumptions, that's possibly a conservative estimate to assume, because to be honest, we don't really know that the R&D expenses are going to have to slow down there, especially when we take it in kind relative to the actual growth rate of the revenues over those similar periods. We can see here the US went from revenue growth rate of about 36% per year for those 2 years to 41% per year. So it accelerated the US revenue growth. And then likewise for international, it went from 72% per year down to 66% per year. So it did slow down for international, but not very much. So technically, even assuming that the R&D cost per growth per year is going to slow, I think is a somewhat conservative assumption. But nonetheless, with those assumptions, we end up saying that in 2032, we'll be up to about 49 million per year in R&D costs, 25 million per year for base assumption, and then 20 per million per year for our bear case assumption. I do have percentages of the sales listed here, but we can pay attention to that once we get the total sales number. So the way I'm building the model up from these R&D expenses, though, is basically assuming that R&D expenses get paid out over time. These R&D expenses turn into technologies that are then being studied by third-party scientists and doctors. They give us information about the third-party studies that have been done on their products over time, which has grown also about 18% per year for the first 2 years, then up to 26% per year for the years after that. And then I also took a look at what the growth rates of these were relative to each other. And in general, the third-party studies growth rate seems to be about 0.7 of the growth rate relative to the R&D expenses. And I'm going to use this ratio as a proxy for figuring out the growth rate of studies moving forward. So with those assumptions, I'm the 0.7, then I'm going to say that it is 0.7 of the growth rate for the bull case and the base case and the bear case assumption in each of these particular cases, which gets me to 10% growth rate for the bull case assumption, 5% for the base case, 3% for the bear case, which then in turn brings me up to just over 200 third-party studies in the bull case, 130 or so in the base case, and then a little bit over 100 in the bear case assumption. These third-party studies themselves, I'm assuming, are going to then lead into FDA clearances over time. I then took a measure of the ratio of the FDA clearances relative to third-party studies over time, and then took an average of what that ratio was, which we can see over the 5 years that I have, it ends up being about half. And the variability seems to be relatively low. So I feel pretty confident in running off of this half measure. And so therefore, for every third-party study that we have in our bear base bull case assumption, I'm going to assume about half of them turn into completed FDA clearances, which gets us to a little over 50 in our bear case assumption and a little under 100 in our bull case assumption. These then lead into the US installed base, which we saw in the presentation. They talked about their total installed base of devices in the US relative to their total installed base international. So then I'm assuming that then once FDA clearances are made for off their technologies, this itself will then build into the US installed base, which went from 2,400 to 7,200 over the 5-year period. Now, I did take a look at the total install base, but I was also curious to take a look at the actual nominal change in the install base, the delta, if you will, over each of these periods, because the way I look at it is that incremental revenue growth is more likely to be driven by the increase of the install bases more than the total install base. The way I look at it is that there's probably a mix between the two, because the nominal total install base is going to give us a ratio of like what percentage of revenues more like a subscription, more like being a member of a club in a certain sense. If you have an install base, it's more like you are subscribed to that technology, versus if you initially purchase the technology, you are an addition to the delta, then that makes it more like you're purchasing a product individually. Like I said, it's probably somewhere in between the two, but I kind of wanted to build this model taking both of those assumptions into account. And so likewise with these assumptions, I then took a ratio of what was the total amount of US installed devices for each of the FDA clearances, which this ratio itself grew precipitously over the 5-year period, growing at about 8% for the first 2 years and then at about 26% per year for the next 2 years. The average over the whole time frame being about 16 to 17%, as well as the average ratio itself being about 174. I saw this ratio as being kind of noisy, so I wanted to know what the average ratio itself was. So then I'm assuming that ratio will grow over time, since it seems to be showing growth over time, but it's going to grow relative to the average to take out some of that noisiness. And then likewise, I don't really know at what growth rate we can safely assume that it's going to grow, since it itself seemed to be accelerating the growth rate over time. So I took a pretty conservative assumption, in my opinion, of how that change is likely to go, assuming in fact the slowest growth rates for the bull case assumption and the higher growth rate for this in the bear case assumption, which you could just as easily have had that reversed. I think this is one way in which I'm choosing to also be conservative in this measure. But nonetheless, it gets me anywhere from about 260 to 390 of US installed devices per FDA clearance. That's the measure we're getting right here. And then with that, I can then build up to the total amount of change in the US installs over the 10-year time frame, that being approximately the difference between the two, which then builds up to the total install base itself over in 2032 over time. Now, to take this back to a grounded point in reality, that's a lot of information that I threw at you. Like I said, at the end of 2022, the US install base was currently 7.2K. So we're assuming that it's going to grow up to approximately around 20,000 or so, 21,000 on average between all three of these cases. So you can see that there's some serious variability between the cases. And yes, you may be looking at this and being like, does it make sense to have a smaller number in the base case versus the bear case? And I would say that it doesn't necessarily make a difference, because at the end of the day, the pricing of these products is going to drive the revenue in a large way. So that's not necessarily going to matter of the actual nominal number of it, so much as their competitive ability to price the products accordingly. So anyway, I did want to compare this US install base against some of the other information that they supplied to us. As we showed in the presentation, they saw there being about 100,000 plus of surgically trained physicians in the United States and close to 200 plus thousand for the international install base. And so we're going to compare our assumed numbers in the 10-year forward period against the potential of the total amount of physicians both in the United States as well as globally. Now, as we had said before, there also is the international portion of the business, and there seems to be generally the delta of the international install base relative to the US install base. There is a ratio between the two of anywhere from 1.1 up to 2.6. I took an average of what that ratio was over the 4 years that we have, and that gets me to a ratio of 1.7. I'm going to assume that that ratio remains the same, which basically means that for every device that's installed in the US, there is approximately 1.7 devices installed internationally. And so based off of the US numbers, that gets us to our installed numbers internationally of around 33,000 across all these cases on average. And then that gets us to our total level of install base globally. Now, as I was just saying, there is in the presentation, it said that we can expect about 100,000 of surgically trained physicians. I then also went and found this article from the Bureau of Labor Statistics for the government website, talking about the general expectations of growth outlook for physicians and surgeons, which they are themselves expecting over the next decade about a 3% growth rate, which is slower than average in this particular space. Now, this is for all physicians and surgeons, but I wanted to get an idea of how many physicians and surgeons would there be in 2032. So taking that 100,000 number and assuming that maybe it grows at 2% per year, which gets us to 121,000, or maybe it grows at 4% per year, which gets us 148,000. Again, that article said 3%, so I kind of chose to do a little bit above and a little bit below that. And then if we compare that to the total amount of install bases that we're saying we expect, that gets us up to the a 7% figure of the current level of 100,000. So they currently have about 7% of all surgically trained physicians in the United States are currently installed with their products. And with our assumptions of growth over time, that gets us to, in our bear case assumption, possibly up to 16, 17%, and just around 17% for our bull case assumption. And then likewise, I said we did the same thing for international, building up our assumptions about international levels of physicians somewhat similarly to the way we did for our US levels. And based off of the current install levels, we see it at about 9.8% of the current install levels. And with our projections for the future, that builds it up to possibly 23 to 24 to 25%. Now, it should be understood that this is not a sense of market share of the physicians, because we are comparing it only to the levels of surgically trained physicians and surgeons, but not all of these products actually require you to be surgically trained in order to use it. Some of these products can be used by other levels of other types of physicians and other clinicians that don't necessarily have the same levels of trainings. So this is really just more of a comparative measure. And also the thing about this is that these might seem like really high percentages, 23, 24%, 16, 17%. But when we're thinking about market share for medical devices, you have to understand that we're talking about what level of physicians can have access to those devices, but not necessarily comparative to a competitor's device. So it's not like saying that InMode and all of their competitors added up together make 100% market share. InMode and one of their competitors, one physician can use both of their products, right? It's not like these are mutually exclusive events. And to somewhat make the case for that, Found this article of Abbott and their market share in one particular segment of a medical device field against their market share versus Boston Scientific's. In this article, it says that they themselves, Abbott, went from 18% market share in 2023 versus a 24% market share that they had previously. So it shows that getting in these high teens, 24% of market share is not entirely abnormal. In some medical device spaces, it can be normal to possibly even get up to 50% market share. Now, a second way of logic checking these assumptions that I've made is I found this article from a trade government website showing total levels of employment in health services as well as total amount of establishment in health services across various states. Now, unfortunately, it only included the top 10 states that it wanted to talk about in particular for the employment specializations in health services, but it gave me at least some level of ability to compare. So what I did is I took all of these states that it listed and the employment levels that it listed, as well as the health establishments that it listed, and I took the actual populations of these states and compared it. It turns out that for these 10 states that it lists, that actually makes up about 48% of the population of the United States. And then I compared what was the 100,000 physician trained or surgically trained physicians that it says that we have in the United States comparative to this total health employment, and it turns out that that actually makes up about 1% of the total health employment. So at about 1 out of every 100 person who's employed in health services in general is going to be surgically trained. And then likewise, that makes up about 0.5% of the total population on average relative to those states. And then likewise, I wanted to take a list of the total amount of establishments in these particular locations and then compare that to the total amount of install bases that we're expecting. So effectively, the installs that we're expecting would mean that about 5% of the total health establishments would be having those types of devices, which I don't think is at all an unreasonable level of total coverage, total exposure for InMode. So coming back over to the main model, now that we have an understanding of our US install base as well as our international install base, now we have to attach an actual dollar figure to each of these installs. So what I did is I took, as I said, a both measure of the dollar figure install relative to the change in the US installs, seeing how much the revenue grew for each amount of installs that's been added on each year by year basis. And then I took that measure over each of the 4 years that we have. You can see there's an average of about $55,000 per install added. But we can see large variability anywhere from 22,000 to possibly 100,000 across the different years. So the average really makes a big difference there versus the total dollar figure of revenue per install that already totally exists, which we can see a pretty large variability within as well, from 30,000 up to into the 40,000s, on average being about 39 to 40,000, a little bit less variability for that figure. And then likewise for the internationals, we can see that the installed per delta growth figures anywhere from 9,000 to possibly up into the 20,000s, on average being about 18,000 across the 4 years. And then the install, the dollars per total install, anywhere from 12,000 up to 20,000, on average being in this 16,000 range. Now, I'll be honest, based off of these averages, it's a little bit tricky to figure out in what way I would think of projecting these price levels, especially considering there's such high variability within the few years that we have. And not to mention also the dollar figure per install level seems to actually be more stable than it does on the incremental delta level, which while I think the incremental delta level makes much more sense, it actually is far more conservative to use that metric. In particular, what I mean by that is that you see that the 39,000 average of dollar installs for the US is pretty low variability. That average seems to be pretty consistent across it, and yet the actual implied level of dollars per install that I end up having across my models is anywhere from 13,000 to 20,000, which is significantly lower than what that average is, which implies the pricing power would be going downward. The reason why is because I actually built it off of the install per delta, and then I still wanted to assume that that dollar figure was likely to move downward over time. So I have it going from 44,000 down to $36,000 down to $31,000 per install, incrementally added per year. And so as a result, I would say that the pricing level assumptions that I am using for InMode are actually extremely conservative, partially just because I feel like I don't have a whole lot of clarity on how to project much more optimistic, much more bullish assumptions for that. So I feel sort of forced to that conservatism. And I likewise use the similar method for the internationals, getting us anywhere from 12,000 to possibly 28,000 on the high side, which gets us similar levels to our 18,000 level. So at least it's not as low as the US particular levels, but still similarly, the total dollars per install, which would average about 16,000 before, across the various modes, it still ends up being about 14,000. So still significantly lower. And what these dollar figures then multiply into is the 31,000 multiplied by the total install deltas that we have, gets us to a total level of about 400 million in US revenues in the bear case assumption, and then possibly up to almost 800 million in US revenues in the bull case assumption. And you can see that the base case assumption also seems to be slightly lower than the bear case assumption in this, but that partially has to do, as I had said before, between the differences in the US install deltas. It really has to do more with the combination between the two factors that actually drives the total revenues. And then likewise, you'll see that in the international revenues, in that particular base case assumption, it actually does end up being significantly higher than the international levels. And that partially has to do with just the nature of the ratio we use for international versus US. But anyway, I still end up with almost 300 million in international revenues in the bear case assumption, and then about 850 million in revenues in international in the bull case assumption, about 350 million in the base case assumption. Combining all those assumptions together, we end up with just under 700 million in our bear case assumption, and then 750 million in our base case assumption, with 1.6 billion in our bull case assumption. So, like I said, I feel like I'm being very, very conservative, basically across all of my pricing assumptions, and then maybe just being a little bit more optimistic when it comes to more of our install base assumptions. Coming over to take a look at our valuation spreadsheet. As I typically do in the short run, I have my assumptions basically going in line with analyst estimates. And then towards the terminal year, we move towards our revenue models assumptions. Because you can see the bull case assumption of about 1.6 billion and about 700 million for our bear case assumption. Coming down to the graphs, you can see the incremental growth cases. And then obviously you can see that the base case and the bear case don't appear to be too far apart, while the bull case is just way, way, way up there. And then I would point out that that's really just one of the only ways that I could build this model, still build in a solid percentage chance of the more bullish aspects of the model that I built, while still maintaining a significant level of conservatism. I just tend to get very, very uncomfortable whenever my models assume very, very high levels of revenue growth over a 10-year time frame. So really, I wanted to isolate as much as of those assumptions onto basically one set of probabilities as much as I could. Coming over to take a look at the margins, we have varying sets of margins across the different outcomes, assuming that the terminal margins are going to end somewhere possibly between 40 and 35%, generally leaning much more towards the 35%. For the first 5 years, on average, we're assuming the margins will be approximately 41%. And then for the next 5 years after that, it'll be about 39%, and then ending in that 35% figure. Coming down to the charts, you can see the kind of the ebb and flow of the operating margins across different profitability periods over the 10-year time frame. And then likewise, you can see the distribution of operating incomes, which is very, very weirdly skewed because of the differences in the revenue assumptions, as I kind of already depicted. And then coming over to take a look at returns on capital and free cash flows, you can see that in general, across the full 10-year time frame, returns on invested capital will remain at extremely elevated levels, really only dropping down into double figures towards the terminal year. But it honestly took a lot of effort to get such high returns on invested capital to come down. That's often the case with companies that seem to have extremely high returns on invested capital. It sometimes takes a long while for that to normalize. But either way, we end up with free cash flow assumptions for the first 5 years of about 184 million per year, possibly around 232 million per year for the 5 years after that, and then ending in kind of like a low 200s figure in the terminal year. We can see the graphs depicting the returns on invested capital with the really high skew levels up front, and then the weirdly bimodal distribution of free cash flows in the terminal year, again based around the fact that we have a weird skew in our revenue assumptions. And then coming to take a look at the valuation itself, the terminal implied multiple that I have across my varying sets of outcomes, generally weighted towards the upper teens level with some skew towards the upper 20s. You can see that gets us a distribution of values where about 50% of the fair values are at between $33 per share and $45 per share. We're trailing just under the median a little bit right now, and as well as about 10% upside to the current fair value. Coming down to take a look at the actual pictures of the fair value distribution, you can see that it is highly skewed towards the right hand side, which means that really there's just a huge amount of potentiality to me being wrong towards the upside at the current price point. And then likewise, that depicts itself in the returns distribution as well. Finally, we can come over and take a look at the simple summary DCF page. As I show it, you can see the basic expected assumptions across each of the variables. You can see it's currently trading at the 49th percentile of its fair value, currently about $40 per share being the fair value, 10% upside, 11% expected returns over the next decade. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So that's going to do it with our valuation of InMode here today. I did in fact take a very small position of it starting this week, so we'll see where that goes. It was definitely a very interesting company to cover and to value, with definitely a lot of complications in figuring out where we think the revenues are going to go over the long run. But I do think that that's partially where a lot of the opportunity lies. So I'll catch you all in the next one. Bye.